But I do want to talk about the dairy situation and outlook. I actually had a bit of an issue with Corey Geiger, who had asked me to do my milk check outlook at a very different time of the year. Normally he asked me to write the column for the January issue, and I'm all in sync with that, but he sent an email this summer and said, boy, my columnist for next month is not going to be able to do it. Could you do the, I think it was July outlook column? And I said, yeah, okay, sure. So I was off my game a little bit. You'll notice that the title up there proclaims that the dog days are over. And part of the reason for this was this one graph that we see over here that indicated that the world's major exporting countries had recovered some milk production, but it looked as though they were tapering off at that point in time. I point this out because opinions have changed a lot since that midsummer time period. In point of fact, if you take a look at the Chicago Mercantile Exchange futures prices for February delivered contracts, you'll notice that in August they were up above $16 for both Class 3 and Class 4. And over this time period from August until now, the February price opinions have eroded by more than $3 per hundredweight. So I was within a lot of company at being incorrect in my prognostications at that point in time. I want to highlight this because trade has become oh so important to the U.S. dairy industry. There are some things that affect milk prices that go beyond trade for sure, including our own domestic consumption or our regional shifts and changes in production. I'll cover a little bit of that, but trade can't really be overemphasized at this point in time. This particular chart is showing you two things. On the left-hand axis, you have the percent of milk production that's exported, and that's shown in the blue line. And on the right-hand axis, you have the U.S. all milk price, and that's shown in the orange line. What you see, however, if you take a look up there, is that every major downturn in milk prices that we've experienced in this country over the last decade and more has been accompanied by a collateral downturn in the trend that we had on exports. So in other words, either, as you notice in this first time period, more of a plateauing, but we were clearly off trend for exports, or a little dip here or a bigger dip here. What happens is that dairy products that we intended to send overseas got made but stayed on our home shores. And ultimately stocks build, and when those stocks build, we see downward pressure on prices. And that is exactly what's been happening for us. Take a look at the cheese stocks here. Bottom line in green was 2014, one of the best years that dairy producers have ever had. Normal levels of stocks for us, maybe even a little on the low side. The yellow line is the following year, 2015, stocks beginning to build, 2016 building more, and 2017 building even further. Those stock builds, of course, are putting downward pressure on the markets. The good news is that we've begun to work some of those back down as we get toward the end of this time period in 2017. So I'm hopeful that we've got some prices that are beginning to move product a little bit more. Why the long trough? Well, we've become experienced with some of these downturns in prices that we refer to as price cycles. But the reason has been that the major exporting countries of the world have been both up and down and back up again in milk production. This was the same chart that I had in the Hordes article that I showed at the beginning. However, it was truncated right about here. This was the last little downtick. This is the U.S. percent change in milk production. It's been behaving very reasonably between 1% and 2%. We are included in the major exporters, 5 of us in there. There's the European Union, there is New Zealand, there's the United States, there's Australia, and there's Argentina in that group. They had all fallen, even though we remained relatively flat during this time period. And since prices improved, they had quite a bit of increase. And as you can see, we're now at a point in time where the total group of that exporters are up about 4%. One of them in particular, and that's the European Union. They, this last month in November, were up 6% increase over year earlier levels. That's a big increase. Europe maintained some of their milk prices with policy instrument that they still have in place. It's a policy instrument fairly similar to our old dairy product price support program, where they're willing and able to purchase product off of the marketplace. The blue line is showing you the accumulated stocks of skim milk powder that were purchased under that, which is a little over 350,000 metric tons, a lot of dairy product. The red line is showing you U.S. commercial stocks of dairy powder. And this skim milk powder in the U.S. or non-fat is relatively flat, but beginning to increase a little bit. So in total, there's a lot of stocks of skim milk powder on the marketplace. This has had some predictable, I think, outcomes. Intervention stocks are now old powder. Some of that product is 3 years old, and it's not going to work to be used in cheese vats to bump yields very well. Cheese manufacturers won't want that product. It can still be used for products like yogurt or ice cream, where that kind of yield is not so important, but I think most likely is the product that will be coming out will compete directly with whey products like WPC 34 and probably be used more for animal feed than anything else. Although I will caution that sometimes in the past when we've had some of this powder coming back out into the marketplace, it gets rehydrated with raw milk and re-dried and kind of goes into what they call the gray market. So it still doesn't function quite like it normally would, but it's hard to find it and detect where it is. But non-fat prices have fallen because of this. This is the CME spot markets for non-fat dry milk over this year, 2017. Beginning of the year, we were above $1 per pound. We dropped to a low of about 65 cents per pound. And just at the tail end here, we've had a very slight increase in production, but no real enthusiasm just yet. And I think that's because the markets have factored a lot of stocks into the precipitation here. Why do we continue to produce? Age-old question. And the simple answer is probably that our milk price hasn't dropped below the fixed cost of production. One of the things that Paul just showed you at a slide a little while ago was the operating costs of production and the milk price. Milk price is above those variable or operating costs of production, but it's not covering the total costs of production. So milk prices would have to fall lower before a farmer would sensibly make a decision to reduce milk production. Rather than the deep cut like we've seen in previous downturns in prices like 2009 or even 2012, those were deep cuts. This is starting to feel more like a long scrape, which is to say we're going into our fourth year of prices that are not covering our full costs of production. And it hurts, but it hasn't hurt enough to make us change production decisions yet. But we've been consuming capital. It's not being replaced at the same rate we normally would for close to 3 years now, and some of those costs that would have been fixed cost in new capital have become more like variable costs in terms of higher rates of repair on equipment. And we are seeing some of that. So I do think we're going to begin to see some changes happening. And we've also witnessed that open accounts at input suppliers, feed dealers and others have been growing. These are signs of the financial stress that Paul was talking about. Let's get down to our milk production. Open accounts at feed dealers are indicative of farms that maybe are having a harder time purchasing all of the supplements that they would want to have to feed their cows under more ordinary years. And partly because of that, we've seen a rather small increase in milk production per cow this year in comparison to what we saw the year before. So milk production per cow has been growing, but at a fairly modest rate. The rate of growth, though, over a long-term period of time is about 2.1% on milk production increases or productivity increases. And that means that just milk production alone means that we have to have more markets if we're going to keep the same number of cows. We've had this improved efficiency increase in milk production per cow over a long period of time. This is an annualized basis for that, and it shows you that the trend is darn near linear. And it's one of the few biological trends that I can think of that doesn't have a fair amount of wiggles and jiggles in this. If Paul had put up the increase in corn or soybean productivity, it would have showed an upward trend, but it would have had a lot of variability from year to year. Milk per cow doesn't. But I want you to focus just a minute on our top 4 milk-producing states. That's California in the red line on top, and Wisconsin in the blue line, starting down here in the bottom. That is Idaho in yellow, and it's New York in green. These 4 states, this is now monthly milk production per cow, have very different trend lines going on. The 2 western states have flattened off considerably in comparison to these Great Lakes states. And I think that part of the reason for this is that we've had this yield increases bumping up against some climate issues. That our high-yielding, high-producing dairy cows, as they're increasing, have just a lot more body heat to dissipate, and that's not easy to do in these warm, hot climates. Part of the reason we see milk production falling off in the southeast and more recently in the west, and part of the reason I think we continue to see growth in this northeastern quadrant of the country. Dairy cows had increased in 2014 when we had strong milk prices. They increased a little bit in 2015 and 16, but 2017 you can see we carried that trend forward. It's a little flat the latter 3 quarters of the year, but some growth in the first quarter. So we've got quite a few cows on hand, even though our milk production per cow is not growing strongly. That's given us this kind of percent change in production. Somewhere between 1% and 2% is normal for us, and we've been well behaved for the most part in this 1% to 2% range. More recently, the last few reports have been down closer to 1% than 2%. This map is showing you trends in states, and this is comparison of 2017's milk production with 2016. You'll notice that there's kind of a diagonal band that moves up in this direction from the south and southwest on up through the Great Lakes states, where they've had increases in milk production. Still quite a bit of decline in the south, deep south, and even the southeast has had some, and especially over here. I draw your attention to California alone, that has had about a 2% decline in production. That, from our largest milk producing state, is a lot of milk loss. And in point of fact, that's been true for the last 3 years. California as a state has lost something like 6 million pounds of milk per day over the last 3 years, and that's equivalent to 1 big dairy plant. And I was not terribly surprised, but it's always a sad thing to hear. Just a couple of days ago that California Dairies Industry, CDI, closed one of their milk powder plants because they simply didn't have enough milk to put through that operation. In contrast, these 3 states up here, and I'm going to point to Wisconsin, Michigan, and New York, 3 of the top milk producing states, they're all in the top 5, have increased milk production substantially and through the last 3 years. Michigan has increased, in fact, they've doubled their milk production in about the last 15 years. The state has doubled. They're now the number 5 milk producing state. On a percentage basis, their increase is still big. Ours is not as big, but over the last 3 years, again, there is no state that's put more milk on the market than Wisconsin has. We've increased milk production about 7 million pounds of milk per day. Michigan has increased in that 3-year time period about 3 million pounds per day, and over here, New York Michigan I think 4 million, and New York about 3 million. So collectively, these 3 states, these lake states, have increased milk production about 15 million pounds per day. That's 3 big plants. 3 big plants that haven't been built in that time period. The milk's been absorbed into other plants. And again, Michigan is the poster child for a place needing a plant, has simply not had enough processing capacity to handle all their milk. And it's just been spilling out up into Wisconsin and all the way over into Pennsylvania and New York. So they need a plant desperately. These dots, by the way, are showing you the locations and relative size of plants in the area. We can build plants, but plants are expensive. It's probably going to cost you $250 million to put in a plant that's large and modern today. That's a lot of money. Where do we put it? Where does it make the most sense to have that plant? What products do we produce in that plant? And probably most importantly, who are your customers out there? And how do you get the products to them? This raw milk that's been coming into Wisconsin and other states is really expensive to move that far. We can calculate something like an implied over-order premium for milk production. And here I'm showing you for these 3 lake states that I've been talking about, Wisconsin in blue again, Michigan in the red, and New York in the green. Our premiums have held up pretty well, except Michigan's has declined and is now negative. So as they sell a portion of their milk at distressed prices and are paying to transport it all the way over here, pooling those losses back to farms has given them milk priced below regulated levels. We've seen a lot of erosion of premiums in New York and Wisconsin as well in the last few months. That doesn't show up on this graph yet, but farms are certainly talking about that. Let's shift just quickly to consumer confidence. Not sure about the confidence of my voice, but this is consumers' confidence in the economy, and it relates to consumption of dairy products in the U.S. We've had, we've had this confidence being relatively high until we fell into the recession of 2009, and we've clawed our way back, and now consumer confidence is well above those pre-recession levels. So in that respect, I think we could say our economy is doing well, and we are consuming a lot of dairy product. But this consumer confidence index is made up of 2 series of questions. One of them that asks, how do you feel about the economy today? And that's the blue line. And the other is, what do you think about the economy in the near future? That's the green line. The red line that we always hear about is the average of these 2 things. So before the recession, we had consumers saying, it's great. My 401k has never been better, but I'm a little concerned about the future. And Steve Deller will probably tell us a little bit later that our U.S. economy being driven by, 70% or something consumption of products does not do well when we begin to be worried about the future. We start to get a little more conservative on our expenditures, and that to some extent becomes self-fulfilling prophecy. It pulls us, drags us down into the recession that we had. Now in the bottom of the recession, how is it today? Oh, it's terrible, horrible. Bank closures, mortgages failing, but I'm optimistic about the future, and we pull ourselves back up. I'm not making a big speech about this for too many things, except that our divergence between where we are feeling like the economy is good today and what we think about the future is starting to diverge again over a long period of time, and it could pull us back down. That said, dairy products have been a good purchase for consumers. The prices have been good at retail. You'll notice that from our high in 2014, we've been well down the last couple of years. Consumers have been buying dairy products. The per capita consumption of all dairy products on a milk equivalent basis increases almost 2 pounds of milk per person per year. And of course our population increases. But even with this kind of increase out here, this is just barely keeping up with our increase in productivity of milk per cow. What we really need is either more exports or fewer dairy cows. Let's just go back quickly to revisit our possibilities for export markets. This is the Global Dairy Trade Index, an auction that's conducted bi-weekly by the New Zealand dairy folks. And this is an indication of the value of dairy products on world markets. You'll note that our bottom down here in 2015 and 16 has been working its way back up ever so slightly, But we have had a fall off toward the second half here of 2017. A little uptick in the last few trades, but nothing that I would dare call a trend yet. We've also had some headwinds for trade because we've had a relatively strong U.S. dollar. Over the last year, however, the dollar has eroded a little bit in value, and that will help us with export markets, but it's not enough to take us back to the halcyon days back here when we had relatively weak U.S. dollar. Let's talk about price cycles just briefly. I mentioned those early. This is a price cycle looking at the MPP margin. That's the difference between milk and feed prices. And this is a margin that's looking at the number of months that we were in the cycle, starting at the high point when we had a $12 return over feed costs, dropped to a low of about $6, and hit the next high around $12 as well. This was a little over 33, I think it was 34 months in length. The next cycle we have started at that $12 level, didn't drop down quite as far, it lasted a bit longer, and finally ended at about a $14 high. This is the cycle, of course, that had 2009 in it. We had some months with barely more than $2 to cover all of their costs and feed for farms. No farm was cash flowing during that time period. This cycle was fairly long and persistent as well as deep, but we did climb out of it. The last cycle that we were in, not a current cycle, but our last one before this that was completed, dipped down nearly as low and climbed to the new heights up here that we saw in 2014 with margins near $16. The cycle that we're in today is this black one. This is why I kind of referred to this as the long scrape. The reason is that we have not dropped very low, barely hit $6 down here at the margin level, but it's been so persistent, we're just staying in this place. And I suspect that we're going to be back down around $6 again as we get out here. And this is likely to be the longest cycle that we've seen by the time it's done and over with. And we're not ready to declare that yet. The alternative to producing milk is culling cows. It's a little ironic that the time period when our milk prices were at their highest, so too were cull cow prices, and we really didn't want to cull cows then, no matter the price of them. Now, and when we kind of need them, we're down at nearly $60 per 100 pounds of beef, and it's not so desirable to cull cows under this market. Here's my price forecast. This is showing you the actual prices for Class 3 and 4 in the blue and red, and the U.S. all milk price. As you can see, I'm projecting a continued downturn in prices before we begin the upturn. I think the upturn will happen in about the second quarter of 2018. So here's my forecast. Our relatively strong U.S. economy has been helping us consume dairy products. World supply of milk fat has in general been tight. It's kind of a luxury item, but the world seems to have strong enough economy to be buying a lot of it right now. But the world supply of milk proteins is excessive. Either we need to find some new emergent economy like we did with China several years ago and provide us a whole new shift in the demand curve out there. But barring that, we're just going to have to buckle down and work our way back down the current demand curve to find a lower price for skim milk solids. The southern hemisphere of the country, which would include Australia, New Zealand, and Argentina as major exporters, is halfway through their production season. But the EU is the one that's really in the driver's seat. Milk has been production tightening in the southern half of the hemisphere with some droughts in New Zealand, part of the La Nina event that's going on right now, but the European Union is substantially up. Unless circumstances change significantly, it's hard for us to see very much optimism in milk prices in the short run. And that's why I'm forecasting that our Class 3 milk prices will be down about $1.35 this year. Class 4 not down by quite as much, but the all milk price will actually be down more than the average of these two. The reason I say that is because premiums are eroding. So it's not just regulated minimums, it's also the premiums that are paid above that. basically the bottom line here, I think, is that 2018, unfortunately, is going to feel a lot like 2016. And with that, I believe I'm at the end of my time. Thanks, Jeremy.